This is episode 243 of the Andrew Hines Real Estate Investing Podcast. This episode is brought to you by Control and Compound Financial. They teach real estate investors how to multiply their wealth using infinite banking strategies. For a complimentary wealth coaching session or to learn more, visit www.controlandcompound.com/Andrew Hines. Welcome back to the show. Today I have Manny Shiferaw on the show, and he is an Eastern Canada investor who took his skills south of the border, and I know this is a common theme lately, and that's because there are certain markets, of course, in the US that seem to work really well. And one of the ones that's been brought up on this show before, specifically by Thomas Larini, is Cleveland, Ohio. And I actually invested in Ohio many years back. Back in 2012, I started investing there. And I didn't have the greatest experience. But full disclosure, I didn't really know what I was doing that well back then, and I had to learn. Well, Manny is buying multifamily buildings and getting some pretty insane returns. So he talked about a plan that between 3 buildings that he's acquiring or already acquired, so he's in the process of acquiring the last one, I believe, he's looking at somewhere around $30,000 or $40,000 in cash flow per month. Now, it's not all his. There are other partners in on these deals. They're using a general partner structure where they have a general partner and limited partners who invest in these deals. And this is a strategy that serious investors use. And this was a serious investor type conversation. Somebody investing at a distance in a market that cash flows and makes sense. I'm always up for a discussion about that. So I enjoyed this conversation, and I think you will too. As always, I just want to ask you that if you're enjoying the show, please make sure you rate and review it. It will help it get out there to more people. And then the best thing you can do is share this show with somebody you think it could help. I'm really looking to continue to grow it, and your help is needed in that process. So thank you very much in advance for doing that. And I want to remind you about the GTA West REI meetup. We're doing that monthly. It's a fantastic opportunity to meet fellow investors, share ideas, talk shop, and grow together. So I highly encourage you to come on out to that. It's completely free. Now, without further ado, let's jump into the episode with Manny Shiferaw. Welcome to the Andrew Hines Real Estate Investing Podcast. I've got Manny Shiferaw. Did I say that right?
Yep, that's it.
Yeah, he's on the podcast here remotely, which we don't do much of this, but Manny's got a cool setup. Nice mic over there. And I'm excited to dig into this. So Manny, you're coming to us from the East Coast. So it was inevitable. We're going to get some distance investors on here. Tell me a little bit about you and what got us to this point, having you on my show here.
Yeah, sure, Andrew. So this is it's an honor to be here, honestly. So I started investing in my investment journey back in 2019. I'm a registered nurse by trade. That's my day job. And I worked as a nurse, maybe for a month or two. And then I'm like, this is tough. Like, I don't know how I can do this for the next 40 years. So I started looking into investments, and I tried day trading stocks, went terribly, lost a lot of money pretty quickly. So then I read Rich Dad Poor Dad, and then I kind of fell in love with real estate. I'm not totally, my mom, she owns one rental property. So we've owned that for, since I was a kid. So I didn't know a whole lot about real estate, but like the concept wasn't foreign to me. So that's when I first started my education. That's when I came across your podcast, the Rise podcast, Bigger Pockets. And I just consumed so much content and learned as much as I could. And then I started, I went out and I bought my first duplex, house hacked it, 5% down. And then after that, I ran out of money. Like, how do people buy more properties after this? So that's when I kind of did some more research, did some more learning. And I learned about the BRRRR model and, raising capital. And I was able to raise some money from my parents for the first deal. I went and I BRRRR'd my triplex. It went perfectly. I gave my dad the cash back, and then I said, plus the interest on top of that. And then I explained to him, you guys can, sit on this money, or else you can give it back to me and I can go rinse and repeat, do the exact same thing. And that's what I did. I was able to just kind of take that initial capital and buy a triplex after that, and then a fourplex, and then a sixplex, giving my parents their returns after every single deal. And then I was kind of stuck because I wanted to do some cooler stuff, some bigger stuff, but I live in Halifax, Nova Scotia, for your listeners. And the market here, just like pretty much anywhere across Canada, it went crazy over COVID. And especially the larger multifamily stuff, 20 to 100 units or whatever, the prices are just absurd. So it was really hard to make the numbers work. And that's when I kind of started diving down and learning about the United States. And my mentor and now business partner was on your show a couple months back, Thomas Larini. So I joined an investment education group called Wealth Genius. So that's where Thomas was my mentor. And then I finished that. And now we're just buying all kinds of properties in the United States. And that's what brought me here to you. I have my own podcast and I was sharing my journey along the way. And then I'm like, I should get on other people's podcasts. So you were one of the people.
Yeah, very cool, man. Thanks for the context.
Yeah, no problem at all.
And you mind giving me like the year range? Like when did you start investing using your parents' money? And then when you went into the US?
So 2019 would be when I started investing here in Canada. And honestly, the US stuff started last year. 2022 is when I first started learning, but I didn't actually buy anything until this spring. So May 2023 is when we bought our first building. And then we bought a couple more since.
And for your US investing, are you focused on investing like close to you? Because I know being in Nova Scotia, you're not that far from Maine. Is that a target for you or no?
Not really. I don't really care if it's close to me. I'm not going to be going there very often. I go there sometimes for the due diligence and sometimes when we close, just, for social media, just for videos and stuff, but it doesn't matter because all of our buildings right now are in Cleveland, Ohio. And that's not super close.
Cleveland.
Yes.
Okay. Yeah, I know Thomas was a little hot on that. So you're doing some stuff in Cleveland with Thomas?
Yeah. So we have 3 buildings there, a 24 unit and 2 38 units. And they're all 3 of them are in Cleveland.
Okay, so 24 unit building in Cleveland. Like, what are we talking here? Is this an on market or an off market purchase?
The first one was on market, man. They were asking 1.5. We put an offer in for 1.4. It got accepted right away, and then end purchase price ended up being 1.35 mil at close.
So 1.35 million for how many units?
24 units, all 3-bed, 1-bath.
3-bed, 1-bath. So 56 G's a unit.
Yes.
And what kind of rent are you getting per unit?
So when we bought it, it was low. Rents were low, mid 700s. But we're getting quotes for close to $1,400. So we're using some Section 8 housing. Yeah. So like it's called CMHA, and they just pay for the rent. But yeah, probably going to double the rent in the building.
You're going to do some Section 8 housing?
We're going to do some Section 8. Yeah.
Oh boy, I'm excited about this talk.
Yeah, this will be a fun one. And I can explain why we went down that road too.
Yeah, we're going to get to that. Okay. But let's not graze over we talk 1% rule. And on a per unit basis, if you started at 700 and 56,000 was your purchase price, you're still doing good.
It's doing good. Yep.
You're doing more than 1% rule to start.
Exactly. And that's
we're talking a building that should cash flow, right?
Oh, yes.
Out of the box cash flows.
Out of the box cash flows. Yep.
Yeah. Are you close to the what are you close to in Cleveland with that building?
10 minutes away from the Cleveland Clinic, which is the biggest hospital, and also 10 minutes away from Cleveland State University.
Okay, so there's a lot of stuff. I mean, some people are like, there's a stigma about Cleveland. Let's face it, it's not far off of Detroit and Buffalo. Like, it's a little bit better.
Yes,
but there's definitely some stigma there too.
100%.
And what do you think the preconceptions of that area are, and what's your response to that?
So there are some areas in Cleveland that are rough, and I'm talking just Detroit level. Like, we would not invest there. Damn near war zone. But the area that we invested in, it's probably a C+ area. It's still on the come up, but if you went and looked at the building, which we did, you can see development happening all around it, every single block around it. And we did a lot of connecting with people there. We talked to different brokers and stuff, asking about the area, and everyone told us the same thing. It's probably a C+ right now, but in 5 years, that's going to be a B+, especially if we do what we're going to do to the building. So this was more of a long-term play. It's cash flowing off the rip. But in 5 years, this area is developing. In Cleveland itself, it's developing. They're putting billions of dollars into their downtown core, and this building is 15 minutes away from downtown.
Yeah, I mean, I'm very, very open to the prospect of investing in Cleveland. Like, back when I invested in Ohio originally, I would have considered Cleveland, but it was expensive comparatively. So in hindsight, it would have been better, but I mean, I wouldn't have had the money to invest in Cleveland at the time. I didn't know what I know now. So that's, it seems like a market with a ton of potential. What was the relationship with you and Thomas there? Like, why did you guys decide to partner? What are you each bringing to the table?
Yeah, so Thomas was my coach. He was my mentor for a year. So we're not allowed to work with our coaches on stuff. So I finished my mentorship with him. And then I was just doing some deal hunting and I found this amazing deal. Like I was the one that initially found the deal and I ran the numbers and I kind of presented it to Thomas. I'm like, Thomas, this deal is pretty nice on paper. You know, we obviously have to do our due diligence. And I asked him, would you be willing to partner with me on this one? Having him on board was imperative because he is a dual citizen. So because of him is why we're able to get financing much more easily, especially on a commercial asset like this. And what we bring to the table is, you know, I helped raise money for that deal. I brought some of my own cash to that deal, and Thomas helped get the financing. And then I also have another partner with us. His name's Ian. He was big on the numbers. Like he analyzes a lot of the stuff. He has a construction background. So he knows, you know, when we do renovations, he's really zoned in on the numbers. So he understands those things. So we all bring our own thing. But as a unit, we work well together.
And a third partner, where is he located? Is he in the area or?
No, he's here in Halifax with me.
In Halifax.
Yeah.
Okay, so for that deal, how much were you guys into it? Like, what was your mortgage amount?
Let me pull up the sheet right now. I thought I had one of them, like the Center Road one. One of the 38s. It's the numbers on that one are crazy, but this 24 unit, it's also pretty good. 24 Cleveland.
Yeah, we could talk about that one too. I'm just trying to get an idea of what you have to come into one of these deals, what your down payment is in total.
Yeah, sure. If you don't mind, we can talk about the 38 one. I have just the numbers right here in front of me.
Sure. Yeah. If you got the 38 one, yeah, give me some context. So would it start with what you paid?
Yeah. So this building, 38 units, this is about 20 minutes away from our building in a better area. So this is a solid B area. When you drive that area, you can tell like this area has already been gentrified. It's looking really nice. A lot of beautiful single family homes everywhere. And the purchase price was just under 2 million. It was like 1.9.
Okay. That's a considerably better deal then.
It is better in regards to just like area and like it's better. I wouldn't
plus
say
your $50,000 a unit instead of 56.
Yes, it is better. So yeah, that purchase price 1.928.
1.928. Okay, so approximately 50,000. And 1.928, you're coming in what, 25% down?
Yep.
That's fantastic. So $482,000 in the US isn't nothing, especially when you're buying those US dollars with Canadian dollars.
Yeah, it's not. Exactly.
That's a big down payment. Now, is there a plan? Tell me about the financing structure and your plan with that. It sounds like you'd be cash flowing out of the box with that one too.
Yeah, we are cash flowing pretty well. So we closed with this one with an interesting way. So we closed with a bridge. So the bridge was like 11%. But it was interest only. And we're instantly refinancing into a more long-term loan. So this one is going to be 6.5%, but also interest only. And that's
for 10 years, is it?
That one's going to be for 5 years.
5 years interest only, and then it goes into an amortization?
Yeah, at that point, we're going to refinance because we would have completed the BRRRR, and then we're going to a longer-term debt.
So this is just a 5-year term. That's it. Only 5-year term. It's not a 30-year mortgage.
Yeah, this one's just a 5-year term.
Okay. And are these with like small funds, or is this like an institutional loan?
This is the more institutional, the 6.5%.
So it's like a bank, like a big bank is offering that?
Exactly. Yep.
Okay. Yeah. I mean, that's a solid rate. So you're not paying those big expensive broker lender fees. You would just be coming into a 6.5% mortgage.
Exactly. Yeah. And the interest only is what makes the cash flow just crazy. Like once this thing
stabilized, that sounds exciting. Tell me about that cash flow.
So, well, we'll talk about like the plan. But once this thing stabilized, the gross rent's going to be around $35,000 conservatively. And we're going to be cash flowing around $14,000 USD.
$14,000 USD per month.
Per month with 6.5% interest only. If we hit our
after
target
paying
rates.
your 6.5% interest only.
So
what's the plan with that money? Are you guys sinking all that money back into the building? Are you going to take out 50% of it? Tell me the plan, the general ideology there.
On the refinance?
Yeah. Well, once you get to that point where you're cash flowing 14 G's a month.
Okay. So at that point, it'll be dispersed obviously to our investors and to ourselves. We have a renovation budget allotted. So like this building needs some work, not a crazy amount of work. The 24 unit needed more work. It was an older building, but this one, it's in better condition. The owners,
you can turn it over time. Like you have stuff that's rented that you want to renovate. Like you're not going to kick everybody out. Like you got to do in Ontario to make anything work.
No. Yeah. We have time. We gave ourselves, the 5-year window to do what we have to do.
So you got a 5-year window to start turning this over, even though right now the numbers work. Now, the 6% mortgage you're going to get, 6.5%, are you going to be getting a higher loan to value than what you paid? Like, are you getting enough to like perfect BRRRR it right off the bat?
Yes, this will be a perfect BRRRR, no doubt.
So immediate perfect BRRRR, like within the first year?
No. Sorry, not within the first year. We need
the first refinance is just coming back to 75% of your purchase price.
Yeah, that's just to give us the better rate and make the numbers work a little nicer.
Yeah, the questions and due diligence of the American lenders is pretty sophisticated, and they won't do that. Like, oh, what did you pay? Yeah, we're not giving you more than that, even if you did it in the last year, right? And they also are stickier about the cash out refis. They don't like it when you're taking money out that you didn't put in. Like they'll pay out your mortgages as is, but they don't want to be putting money in your pocket.
Oh man,
these are just things I've noticed. Like the conversation, like they're sophisticated. I've also noticed that they speak to me in a way that, kind of like they're speaking down to me a little bit. I don't love that, but I mean, some people will say this is just part of the game. Like you are going to deal with types that are like that, and preferably, I try and find people who are mutually respectful, but there's a lot of those lenders out there. I don't know did you speak with them directly or did Thomas set all this up?
Thomas did handle a lot of it, and this was actually quite the headache for him. There was a lot of incompetence with this close. That's why we had to close with the bridge. This close was dragged on for like 3-4 months when we could have closed the way that we're closing it now, or we could have done that months ago, because we were initially going to get like a really low loan with like a Franny mortgage, but didn't end up working because our lender was talking with somebody else. It was like almost like 4 tiers to it. So we had a broker, and then there was another company that packages up the loan that then sends it to like the actual bank. But there was just miscommunication along the way, and it just delayed everything. So we're like, frig this. We're just closing with a bridge, and then we have to do what we have to do.
Yeah, it often comes to that, right? I mean, but with such a great deal, there's meat on the bone. You don't need to worry about those few dollars and cents. And this is why sort of what I strongly dislike about what's become of Ontario is people are having to bean count to make their deals work. Like they're having to, every little cent matters. And if we can do this, and then we can achieve our break-even cash flow. And I'm like, for what?
Yeah. Same with Halifax. Exact same thing.
Yeah, just try and find break-even cash flow.
Yeah.
At least I'll say that your purchase point in Halifax probably makes more sense against incomes. Like the purchase price against incomes compared to Ontario. That's all I'm saying.
Compared to Ontario, yes, it's crazy, but like it's not far off. you would think the market got crazy here. So it's not quite the same, but I'm talking like, you're dropping 160, 170K for old stock, with rents that are still around $800, and like it's not a landlord-friendly province. So like, how are we going to get these people out? Like people bring me deals.
So you're still buying a house for under 200K though in Halifax?
Sorry, I meant per unit on an apartment.
Per unit. Yeah. Okay. Yeah. So, and I don't think you're finding anything under $200 a unit in Ontario, but it's not that terribly different. You can occasionally find a deal.
Okay.
But that would be in Halifax proper that you're talking?
Yeah. So like old stock needs a lot of work, low rents. You can find something 150K, 175K.
Yeah. And those deals really are probably only going to make sense to institutional investors for the next bit. And those are the type that can weather the storm for 5 to 10 years while they chum up with politicians and get some new laws passed that allow them to cash flow. So it's kind of a real estate with a plan. But it's a more political one. I see that sort of as being the future in Canada, a lot more of that type of thing where people are going to have an angle with certain, people, policymakers, we'll call them.
100%. Or like we have some multi-generational families here that just have been buying real estate for 50 years and their cash flow is so immense that they can't afford.
They can afford some dogs with anticipation again. And there's some crony capitalism going on there, working things out with politicians. But I also think there's a lot of people coming into the country that they come from places where they earned money not under Canadian tax system. So they were earning money hand over fist. And then they're bringing in so much money into the country that they can just sink it into assets that they think, even if they'll only go up a couple of percent or a percent a year or whatever, they just see Canadian real estate as safe. So they'll go in no mortgage. And that's an element that also contributes to pushing these prices up.
Yeah.
So it's funny. It's funny how quickly all this happened to just drive real estate out of the reach of the average person in just a few years' time, really. Yeah. Right. Like
quite literally.
All they had to do is jack the interest rates up and it just completely out of reach for most at this point.
Yeah, man, like since COVID, right? That's like when I've seen like it's just been out of this world. I bought my personal residence, 2020, and like it's doubled. And now it's like this whole area where I live and all around Halifax. Like I have so many friends, in their 30s. Buying a house is almost out of reach, and it's only getting worse.
Hi, friends. I just wanted to take a moment away from the episode to tell you about my brand new structured coaching program. This is the first time I've ever offered a structured coaching program where we'll have regular meetings in addition to an intro call to go through what your goals are and help you get on a plan to achieve those goals within real estate. So if you've followed me for some time and you feel that I would be a fit for you to help you achieve your goals in real estate based on my skill set, based on the topics we cover on this show, I encourage you to head over to my website, andrew-hines.com/coaching, and fill out the questionnaire so that we can schedule a call and figure out if it's a fit for us to work together. Let's face it, most people could benefit from a second set of eyes and ears going over their strategies, different deals that they're looking at, and helping to springboard ideas back and forth. This is a program that's exactly for that. So if you're looking to build confidence in what you're doing in real estate investing and get very clear on what it is you're trying to accomplish, this might just be the program for you. Take a moment, fill out that questionnaire, and let's schedule a chat. Yeah. So, I mean, this is why so many of our friends in the real estate space are taking their skills south of the border or north. And we have people, going up north to Timmins and North Bay and all that stuff in Ontario. And I'm sure for you, like what would people do if they didn't go to the US? Like if you've got, your kind of crew of investors in Halifax there.
Edmonton or New Brunswick, Alberta or New Brunswick.
They're going out of province. They're going to New Brunswick but New Brunswick's not far, right? Like
New Brunswick's not far at all.
What are you, like 4 or 5 hours to?
Yeah, like maybe 3 hours to like Moncton. So it's not bad.
Yeah. Have you considered investing there?
I have 100%. Like, so I have people bring me deals there every now and then. And it's just kind of like, where do I want to focus my energy at the moment? So I have no problem investing in New Brunswick. I would pick that over Halifax right now.
So you mentioned before, like you gave me 2 deals there. So between the two, are you looking at like $20,000 a month in cash flow? Probably something like that when you get it all stabilized?
Yeah, so there's 3 of them. There's another 38 unit that we're closing on as well. So it's 100 units. And yeah, it should be north of that, I would say, once it's all
like you're gonna be like 40,000 a month cash flow, something like that, or maybe not quite that, but
they'll be doing well.
All right. So who is that being split with? So you got the 3 partners, but then you guys have also raised money on promissory notes, or you have a GPLP, or what do you have?
So yeah, it is GPLP, but actually the team's growing. So like the first 24 units, it was just like me, Thomas, and Ian, 3 of us. We're the GPs, and then we had 3 or 4 people on the money side. But then the next 76 units, we brought on a couple other team members because like our plan is just kind of massive expansion down in the States. So, after this 100 is just like the starting point. It's going to get much crazier. Yeah. So we brought on another GP. His name's Suman. He's helped us a lot with the raising the capital. And then there's a couple other guys. So the GP team's grown to like, 7 or 8 people. Now the equity, but the equity positions of some people are much smaller because their roles are much smaller.
Right. So how much of your total ownership is segmented off for the limited partners? So your investors?
50%. Except
50%?
one of the deals, the LPs got 60% because one guy and his brother brought all the cash. So we're like, okay.
Yeah. So if they make it simple for you.
Exactly. But so these Ohio deals have been 50-50 besides that one. But then future deals, like we're looking at 149 units in Texas, and that one's going to be a little different. That one's going to be 75% to the LPs.
And that's more typical in the States.
Yes.
So in the States, it's like, 70-30, something like that to the LPs. We're so used to 50-50 here in Canada. But if you play in these big deals,
yes,
that 30% you keep is something special. Now, with that said, there's such a steep learning curve to learn how to play in this game at this level that you're playing. And why most don't get there. Interestingly, my friend Nick came on the show a couple times. I'm not sure if you're familiar with him, but he's doing storage development in Texas and in Florida. and he's done 70% to him, to the limit, or to the general partners, 30% to the limited partners, raised it all in Canada.
Wow.
And I feel like Canadians are more accepting of that. Like they're more
100%.
Americans less so.
You're right. Like 70-30 is what I always see, so, but I heard a great podcast on this exact topic. It's all deal dependent. If you have a smoking
deal is juicy,
stupid juicy, like this is a home run deal no matter what, then it's like, okay, you can kind of skew the numbers in your favor a little bit, or you can make them more a little equal. And a lot of these 70-30s, they'll be heavier on the fees. So like the GPs are getting paid through fees no matter what. So sometimes get rid of those fees and then take a little bit more equity.
Right. Yeah. So you could do the 73 and just stack some fees for yourself on there, and you're making money on the deal. You're making money if the deal does well. Tell me a bit more about how that structure works. Like, are you guys getting a management fee, or is it just on the cash flow of the business? Like, how did you structure it?
It's a funny situation about this deal. So this deal, it's actually somebody else brought it to us. Thomas had a connection. This guy found the deal, did all the due diligence, created the package, all that stuff. Great deal. Over $2 million of equity on the buy. So this guy handled everything. He just brought it to us and said, do you guys want to be a part of this? And if so, just help me raise the cash. And then you guys can have 20% of this deal, and he'll take 5%. And then there's fees involved. So all that to say, I don't know a whole lot about this deal just yet. We're still really in the beginning phases of this deal.
This is the Texas one you're talking about?
The Texas one, yes.
Yeah. Okay. How many units is that going to be?
149.
149. But what about the ones in Cleveland? Did you structure that to take a management fee as well? Yeah.
So like, we're not super greedy. Of course, we saw like we're getting a good equity piece. So there's an acquisition fee involved, like 2%. Yeah.
So 2% acquisition fee, and then do you have an ongoing amount as well?
Like anywhere between like 1% to 2% for the asset management fee, and then
1% to 2% of rents, like, or gross revenue
the purchase price. Like on the
purchase price. Yeah, but that on an ongoing basis?
Oh, sorry. No, you're right.
Yeah.
Of the rents.
Of the rents. Okay. So 1% to 2% of the rents. And then plus, like, do you get an equity stake? And I'm just asking because this is something I'm always curious about, the whole GPLP structure and how people do this. So like, do you get an equity stake for your management?
Yeah. For putting the deal together, 100%. Like, so the way that we have it set up, like Thomas is getting a bulk of the equity, especially because he's the one that's the primary on the loans, and he's the reason
out of the 50% that's available for the general partners.
Exactly. Yeah. And then the rest is dispersed kind of evenly based on how much capital you raise and how much work you're going to put into the deal. And we're all
okay. So how many limited partners you brought in dictated how much equity you got in the deal.
Exactly. So we kind of like allotted it like a third for the loan, a third for the capital raise, and then a third for doing the work on the 50%.
Okay. So what work is involved for you guys? And actually, not to sidestep. So did you guys all roughly raise the same, or was mostly you and your other Halifax partner?
No, it was pretty even. Like the first 24 units, I raised a good chunk on that one because I put some of my own cash, and then one of my buddies that I brought into it, he brought a lot of cash. But then like the other two, so like for the one building that we had like one person bring all the cash. I didn't bring that guy. So another person brought that guy in. And then for the other deal, like one guy, Suman, raised a good chunk, and me and Ian and Thomas, all of us kind of did it. It was pretty even.
Okay. So like approximate ownership in these different deals, like are you around, I mean, of the ownership available equity, like for the general partners, are you generally around 20 or 25% of that in any given deal?
For the first one, the 24 unit, I'm about 23% in that one because I put a good chunk of my cash in that one.
Gotcha. Oh, that's just in total, like the total ownership of that deal.
Yeah.
So you own a good piece of that one.
Of the first one, I do.
Yeah. That's awesome. So every deal's different. You own a different piece. One, you might only own 10% of it or 5% of it or whatever.
Exactly.
These are small percentages potentially of some pretty big numbers in rent coming in. So you're still going to be getting quite a bit. And in your distribution, like, do you guys have a set amount that you're going to get the account for each building up to a certain level, and then anything after that is distributed?
Yeah, exactly. Quarterly to the LPs and to the GPs. But like the LPs need to see some cash flow. And like our goal is, after like 2 quarters of owning the building, we can kind of fill those vacant units, turn over or renovate the ones that need to be worked on. And then we have strong cash flow, then we can start dripping it out to people.
I like that. Yeah. It's great that you can offer a return to them.
Yeah.
And I do have a question about this on the GP side, because I've heard this from an accountant. I've got a few tax opinions on this. If part of your acquisition fee is units in the project, then that's a taxable event. Is that your experience, that you had to report that to your accountant and they had to like basically charge you? It's essentially income. If you're working for units in the building, the government's treating that as income.
I'm not positive, because we kind of just took the fee like as just cash. So we will have to claim that income, because that was just...
You took the fee as... Oh, you did. So you didn't, but you do have ownership stake for your efforts, right?
Yes. Oh, yeah. And
so that part, yes. Hypothetically, like you don't have any cash to show for it, but you'll be taxed on it, is what I've been told. And I'm just curious if that was your experience, but I guess you will find out on your next filing.
Exactly.
Something to learn, maybe something to budget for.
Yes.
And I don't know. I haven't really dug in on this topic. I've just heard this. So, dude, super interesting. And I hope you don't mind me digging in on this.
No, please do this. That's why I'm here, to share the story.
Yeah. Well, what do you usually get into on your podcast? Like what's the theme?
We just talk about it, like anything real estate related. We were trying to really create something, when I first got into real estate, I was listening to your podcast, so many podcasts. I'm like, what would I have liked to hear? And we kind of make it around that. Just stuff for new investors and some more seasoned investors too. We're starting to take on more guests as well. So, you're more than welcome to be a guest on our show at some point if you got time. But we'll do
a virtual session. I'm not going to be out there.
I'll fly you out, man. I wouldn't mind. But yeah, it can be a virtual session. But yeah, we just talk about all things real estate. We talk about the economy too, some stuff like that. Just kind of a macro level stuff, how it's affecting real estate, little things like that.
Yeah. Yeah. Give me your scoop. Like, where do you see the next 5 years going for Canadian investors? I know we talked a little bit about this. Like, where do you see a lot of opportunity? I'd love to get your take.
Oh man, in Canada, it's interesting, man. A lot of people ask me like, Manny, are you just giving up on Canada? And it's like, I'm not giving up on Canada per se, but it's just, I heard someone say one time, why invest somewhere where the rules are just actively written against you versus somewhere where it's written in your favor? So that's the big reason why I went to the States. But, for Canadians to invest in multifamily, New Brunswick, Alberta, I think it's really important to invest in places where it's landlord friendly and there can still be cash flow on the buy, especially in these high interest environments. If you're investing in places, like Ontario, where it's hard to find cash flow and the rules are very much written very much against you, it's tough. It's, you have to be a real savvy investor to make it work. I also like development. That's something I'd like to dip into at some point.
Okay. So that's in your horizon.
Yeah.
And I agree with you. Like, why push your business uphill? And a lot of people are struggling with this. And there's certainly some that are just, no matter what, they're going to keep investing in their home province, if that's Ontario or whatever. And I have like a whole show where we talk about Ontario deals, because there's some that's just what they want to do and they're going to do it. So we're going to talk about it, but you got to get more creative, of course. And like you said, it's kind of, he's kind of playing in a market where the rules are against you. But there's always a way to find opportunities and make opportunities.
Exactly. Like, the off-market stuff, that's kind of what I preach to a lot of people, like finding something on Viewpoint, which is like our realtor.ca here in Nova Scotia. You're not going to find many good deals on market. You have to really work hard. You have to go the extra level.
Okay, so I have a couple of questions. One, I'm going to talk to you about your analysis to find properties. But two, well, before I get into that, I want to ask you about career. You were a nurse, and that's a past tense. So you quit doing that?
So I'm still a nurse technically. I work 0.5. So my schedule is pretty sick. So I do 2 night shifts and then I'm off for 7 days. And then I work another two night shifts and then I'm off for another.
So are these 12-hour shifts?
Yeah, 12-hour night shifts. Yeah. And like where I work, it's a rehab hospital, like spinal cord rehab. So it's not busy at all. So the patients go to bed around 10 or 11 and there's not.
So that's basically part-time. You're half of a full-time work schedule.
Exactly.
Yeah. So half the salary, half the schedule.
Yes.
That's all right. Yeah. And why do you keep doing that at this point? Do you need to? Is it more of just it works for you and your schedule? You don't mind it? Tell me a little bit about that. Like you have a rental portfolio where you are. So I'm just curious.
Yeah, so I could stop. I've talked to my wife about that, and I was going to, but then I thought to myself, it's not that hard. I'm not working very hard at two night shifts at that. I can do real estate stuff overnight when, everyone's asleep. And it makes me $2,000 a month, relatively passively. I'm not working that hard, making $2,000 a month. So I delayed it a little bit. I'll probably stop at some point, maybe this year, later in the year, or early next year. But it's more of a comfort thing. It's like $2,000 guaranteed. But the thing about being a nurse is I can just go casual and they can call me and ask me if I want to pick up a shift. And I can just say yes or no whenever I want. There's so much need for nurses to work.
Well, interestingly, on that point, like you have an opportunity in the US, do you not? Like they need nurses there too. I bet you could probably get a visa quite easily on that pretense.
100%. And I've thought about that, but like, I want to stop nursing. So
you could be a part-time nurse, so they probably want you to be full-time.
They would probably want me to be full-time, or I'd have to move there. If it was like something virtual, I don't know what kind of virtual nursing there are. I haven't
virtual
really
nurse.
Yeah, I would do it, but in the meantime, I'll just stick it out here until I can just comfortably stop.
Nice. So I wanted to jump into to deal analysis with you and how you're finding deals. So tell me about the tools. Tell me about the general parameters you're looking for when you do a search, and what tools you use to find a deal where you're looking.
Sure. So like mainly in the States, or like when I was looking here in Halifax?
No, we're talking the States now. I mean, because you're not really actively looking in Halifax. It doesn't work the same. I'm trying to stay away from, I want to give people current information, like what's currently working. And for you, currently is Cleveland, now Texas. But let's talk about that.
Yeah, sure. So in the States, man, there's so much data. There is so much data compared to Canada. So I have access to this one program. It's called CoStar. And I don't know if you've heard of it, but CoStar is absolutely, it's amazing. It's amazing. It has all of the multifamily data, like all of it, on market and off market. So CoStar, it's like so have you heard of LoopNet?
LoopNet, yes. So I've used that.
So CoStar is like the parent company of LoopNet. So LoopNet's the free version and CoStar is the paid version. So it's like LoopNet, but on steroids. So you can go on CoStar and you can search up, let's say you put in Ohio, and then you can look for a range of units in an apartment. Let's say you're only looking for 20 units to 50 units. You put in that range, and then it'll give you every single 20 to 50 unit apartment building in that state that you're looking at. And then on the right side, you can filter it down even further. So if you want it built after 1985, it'll give you every multifamily in that range built after 1985. And then it gets even crazier. You can see what kind of loan they have. You can see who owns it. A lot of the time it has their phone numbers or their email address of the owners. And then you can do what you got to do. Reach out to them. Cold call.
Yeah, so you'll send them mail or whatever.
All of it, so
yeah. This is similar to PropStream then as well?
Very similar.
Do the same thing with PropStream.
Yeah, very similar. And then it gives you comps about the area. It'll give you data, research. It'll tell you, what market rents are. It'll give you market rents of that whole area. It'll pull up every single apartment that's in that vicinity, and it'll say, 2 bedrooms are going for this, 1 bedrooms are going for this. It'll tell you the demographics of the median income of this area, all that stuff. So
okay. So are you looking into any specific ratios? Do you look at average rent against average income ratio? Do you look at rent to purchase price ratios? Is there general parameters you can put on the software to kind of exclude cities, markets, places that you don't think are going to work?
I don't think you can filter by ratios like that. That'd be pretty sweet. But you can put in like rent parameters though. So if you want an area where the average rent is 1,000, you can put that in there.
But you can also set the parameter of average purchase price, or average sale price. So then you can kind of establish that ratio too.
Exactly.
I'm just curious if you could do like a whole country search, apply those parameters, and then kind of see the different areas that would work. And then you can zoom in from there and look at those specific areas.
100% you could.
Yeah. Did I give you an idea, or does that sound not useful?
No, it does sound useful. It would help you kind of just find an area. We already know what kind of areas that we're looking into. Like we have states in mind, landlord-friendly states that have affordable price.
Like Ohio is obviously people sing the praises of Ohio because of being landlord-friendly.
Ohio's pretty landlord-friendly.
What other states?
So Texas, obviously.
Texas, yeah, known to be landlord-friendly.
Florida, Florida's nice.
Also, yeah, very landlord friendly reputation. Yeah.
The Carolinas, North and South Carolina, we like those. Those
states.
Are
landlord friendly because those are blue states, right?
Are they both blue states? I thought one was a swing state.
I believe so. I'm no expert, but I believe they both are.
I haven't dove into it, but we just like those areas.
I love those areas. Yeah, I mean, they're beautiful states geographically.
Tennessee's also a solid state.
I hear great things about Tennessee. Yeah.
So those are the ones. Honestly, when I first got into all this U.S. stuff, I'd reach out to 1,000 wholesalers, a bunch of brokers, and I just said, send me all of the U.S. deals in landlord-friendly states. And there's a lot of landlord-friendly states. There's a lot of Republican states. So we really have to zero in.
Yeah, you kind of start with what's a red state. Generally speaking, those are going to be more landlord-friendly.
Yes.
And there's definitely a starting point, and you can keep going from there. The thing I really like about the States is like we just watched the opportunity in Canada evaporate to some degree. There's still opportunity, don't get me wrong, but they haven't, in that progress, they're still further behind. So there's still an opportunity there, and might as well get in while the getting's good is kind of my thought. So, that was a big thing that drew me to the States.
Yep. Same with us. Like, the landlord friendly aspect of it's just massive. It's so difficult when you have a rough tenant at scale too. Like I'm sure I just recently read an article in Toronto about just tenants just not paying rent, like a bunch of them, and like they'll just like not pay their rent. You must be aware of this just because they don't want to.
Yeah, I mean, there's that power and numbers thing. I think a lot of tenants are really gaining power these days. There are groups that talk about the whole cash for keys things. That strategy doesn't even work as well now because people talk about it, get together. So yeah, I do think that's a big thing in Ontario, and I think that landlords are maybe going to face a little bit more of a negative attitude from people in general because it's funny, but there's like a bit of and I didn't even know about this because people are just so positive in our circles, but there's like a negative attitude about landlords and a little bit of hatred there. So for that reason, I think that's another reason to kind of look even just outside of Ontario, like or to paint even the entire province with one brush. It probably isn't fair. You could probably go more north and not have that sentiment. But just as people start finding it harder and harder to own, it makes it easier to point the finger. And we all know who the government's going to want to blame, right? They're going to blame greedy landlords. They're always going to create narratives that, it's not us. It's those greedy landlords. They just don't want to give you a deal. Illogical as it might be. So not that of course, my listeners and viewers have heard me talk about this stuff, so I don't want to go too deep into that rabbit hole right now. But for sure. So tell me about where you're looking right now. I know Texas kind of came and fell on your lap, but if it wasn't for that deal, what's next on your agenda? Like what's filling your days with research these days?
So if it wasn't for the Texas deal, we like Phoenix, we like Arizona as well. Thomas's dad has, go ahead.
Yeah. And just like what's good? Like, tell me what's a good parameter. If you're are you looking for a market where you can find a 1% rule?
Well, yeah, honestly, the Cleveland stuff in any of those states where like the price per door is low, you're probably going to hit the 1% if you find a decent.
So price per door is the starting point. Price per door, where are you looking price per door wise? Like what's like, hey, I'm not even going to look at that. Like what number do you have to be at before you're saying, nah, I'm not even going to look?
Around 60, but it also depends on what the ARV price per door is going to be. Like if we buy something and it's like 75, but it can be worth 150, we'll look at that, of course. We'd be silly not to. But price per door, it has to cash flow on the buy. Like that's a big thing for us. We're not here to, or if it doesn't cash flow on the buy, there's a very clear reason why it doesn't. Like there's a lot of vacant units and we can easily go in there and fill them. Yeah. And then it's making money off the rip. So like, that's probably the only reason I can think of.
So those are your parameters. So what are you thinking your ARV on the Cleveland stuff will be? Cause you bought around 50 to 57,000 in that range per door. Yeah,
we want to get it to about 80 to 85. That's the goal.
And the market will support that. Appraisers will support that. What's the highest end in Cleveland? Like what's the most anybody's paying?
Like 95 for something real nice. The thing is, like downtown Cleveland, it's a little bit of a different beast. There's some stuff there that's very expensive. It's like new builds. Okay,
so that's like the unicorn that doesn't really speak for the rest of Cleveland.
Exactly.
Are suburbs in play, or you just wouldn't find multi buildings out in the suburbs? I guess you wouldn't.
Not of the size that we're looking, not really. Except the ones, the 76 units, the 238s, they're pretty close to like a suburb. Like there's not a whole lot of like purpose built multis like them around.
Yeah. Okay. So those are sort of on the outskirts of town, like not really in the main core.
Not in the main core of Cleveland. It's like it's pretty much a suburb. Yeah, it's called
Which
Bedford.
is kind of what you want, right? Like you don't want to be where all the stuff's happening.
No,
in Cleveland,
exactly.
I'm guessing.
Except it's funny you say that. There was actually a shooting in one of our buildings.
One of your buildings.
But it wasn't tenants. It was just like kids going by or something, and they were just happened to be around there, and somebody
just a bullet flew through the window.
Yeah.
I'm just joking.
But
this is kind of what you get into, though. Like, tell me about what's different there. Like, how is it different operating in a city like that, in a space like that? I mean, you're in an okay neighborhood for that city, not in a bad neighborhood per se. But are there bars on all the windows on the lower floors? Do you have, special tamper-proof glass? Like, what's it like?
We don't have any of that. But it's funny you mentioned that. On the 24 unit, before we bought it, me and Ian, one of my partners, we went down to Cleveland, and it was like 10 o'clock at night, and me and Ian just went to the building because we wanted to see it for the first time. And we were able to just open the door. Like the front door was open. We walked in. We were able to walk all around the building. We were able to walk into the basements and walk around. So we were thinking to ourselves, this is not safe. Like any homeless person could just come and camp out in our building. So making them safe is one of the things that are imperative to us. So we're adding security doors, security cameras, little things like that to kind of.
So really those locks that are attached to network cables to like open it up, like a fob system, all that stuff.
All of that, exactly. Buzzer system to make it much more safe, and we can ask for higher rents because this.
Yeah, I mean, people with the safer building, right? Like they're going to look at that. Like, is it normal to put bars on windows there on the lower floors to stop people from? No,
it's not. It's not that bad. It would there's an area in Cleveland, East Cleveland. That's where you want bars on the windows.
Yeah, you see that there.
Yeah.
Yeah, I remember in Miami, we just went out for breakfast one morning, and then we were walking over to this like art graffiti area. You've probably heard of it. I can't recall what it's called, but to get there from the breakfast place to there, we were just like, oh, it's just a short walk. We walk down the street. Every house has bars in the windows. We're like, guys, I don't know if we were supposed to be here.
Gosh, yeah.
We were fine, safe. But it's just funny how quickly you might walk down a neighborhood like that in the States. Do you find that like you go 2 streets over and it's like a different neighborhood? Not
2 streets, across the street. Like it'll literally,
across the street's different.
It'll go from like war zone, F, rundown apartments across the highway, $1 million single family homes. It's shocking. You hear people say it all the time, but when you actually drive and see it, it's totally different.
I think a big part of that is the school zones, because they'll have school zones that are, you might be just the other side of the highway, but you're in a different school, right? So parents are thinking, oh, well, we want our kids to go to that school, not the one in that F zone, exactly. That F neighborhood.
No, you want to stay away from those. And the thing is, like, if you don't know this stuff, like you just look at the numbers and think, oh my God, we looked at this one deal. It was like 70 plus units and it was like a $1.5 million, something crazy. I'm like, this is unbelievable. This is the best deal ever. But it's like, this is the worst part of town, all kinds of drugs, all kinds of crime.
Yeah. What can you do to eliminate that, like from your computer without going there? How do you go about weeding out those potential neighborhoods? Do you pull up like the crime map on, what is it, Trulia? There's one of them has a crime map on them.
There's this awesome website. I forget it off the top of my head. I'll send it to you so you can share with your followers. But it has, especially for Cleveland, it'll just have like a map of the whole city, and then it's like color coordinated of like A, B, and C, good areas, bad areas. So that's one like quick way to do it. But then after that, you have to talk to people in the city. At the end of the day, that's what you have to do.
Well, but I know I used to do this with, I think it's Trulia, if that sounds correct, but there is a crime map and you can actually see the number of reported crimes, what the nature of the crime was. You can see the incidents against the addresses. Like it's very precise. And so you can see the concentration where they're happening more. And you'd be surprised, like every neighborhood has reported crime. It's very common.
Oh, I believe it.
Yeah. So that's, that I've used in the past, and I might be calling that by the wrong name, but, that's one thing that it sort of does what you said. And that's something I would want to do. And then I would see you'd need to kind of find like a base level. Like, go to one of your existing buildings, see what the crime's like in that area, and then compare and contrast against other areas and how many reports there are. And that might help. But then again, like you said, there might be an area where the cops just don't even go. So there's no reports, but it's terrible.
Yeah, exactly.
There's you like you said, I think your final point of due diligence is always to go there. But you could do Google Street View, but sometimes that'll deceive you, right? Because you could do that in Hamilton and see some pretty not great looking stuff that is actually okay neighborhoods.
Right.
So that might tell you the wrong story as well, right? So that's it. That's all you got. You're gonna have to go there.
Go there,
or talk to people.
Talk to people. That's the big one, though. Like before we nail down on our property managers, like I talk to maybe a dozen different ones to make sure that we pick the right ones. Because, if you have the wrong property manager from long distance, it can screw you and ruin the deal.
But before you completed these properties, you probably talked to property managers, right? Before you firmed your deals.
Big time.
Hey, what do you think of this area? Like, are we barking up the wrong tree? Is this a building you would want to manage? Because they'll tell you, because they don't want to take on a dog.
Exactly.
They want to take on one that they can manage.
Yeah. Especially like the first one, the 24 unit. We'd use different property managers to kind of get a base of what we think the rent could be. Because like on CoStar, there's rent comps, but at the same time, I'd like to hear from a person that's actually leasing out these buildings. What are rents for nice 3 bedrooms, nice 2 bedrooms, and we kind of go from there. And we built 100%. We built a great relationship with the one company, and they're managing all 100 of the units.
Cool, man. Anything else that you wished I'd asked you about that I haven't?
Honestly, man, this is most of it. The US stuff, the journey, the podcast. I wanted to talk about that. The benefits.
Tell us about like where people find you then. Like, how do they learn more about you?
So you can follow me on Instagram. That's where I'm pretty active on. My Instagram handle is Shift Properties. I'm starting to get big on TikTok. I'm trying anyway. So if you search my name,
all right.
So when I say getting big, I have 181 followers. I'm just posting there more frequently.
Dude, that's huge.
So Manny Shift on TikTok, or listen to our podcast. So me and Ian and my other friend Janelle, we have a podcast. It's called the Refined Real Estate Podcast. We just talk about real estate. We talk about life. We give some fun opinions, some stuff like that. But you can reach out to me directly on my Instagram or TikTok, or give us a listen on Spotify or Apple Podcasts. We're on YouTube as well.
Manny, it was really great talking to you. I appreciate you doing this. And I know I've rescheduled on you a couple times. So I appreciate you putting this together with me. And we did it virtually. And really, really important and valuable talk. Like the stuff you're doing. I think this is what people around here need to hear. So that's great, man. Thank you.
Thank you. Thanks for having me on. This has been on the bucket list. Now I get to check it off.
Sounds great. All right, man. Well, let's stay in touch. Keep me posted as you're doing more deals. I'd love to hear all about it.
Oh, awesome. I definitely will.
All right. I'll talk to you soon.
See ya. Bye.
There are a lot of people out there talking about the infinite banking strategy and whether or not it makes sense for them. To find out what it's all about and if it's a fit for you, visit controlandcompound.com/Andrew Hines, where my audience can gain exclusive access to books, podcasts, and webinars tailor-made for real estate investors. Have you noticed cash flow in today's market has been getting harder? As a result of the changing market, I've noticed a lot of investors focusing more on passive investing strategies, including private equity. Tune in to learn what these investors are doing at my passive investing webinar happening at 7 p.m. on October 25th, 2023. Special guests Carmen Campanero and Nick Wright will discuss how private equity works, what REIT investments are, what to look for, and even how you can have your RRSPs and TFSAs invested in real estate when it would otherwise not be possible. Space is limited, so be sure to reserve your attendance using the webinar link in the show notes of this episode or by visiting andrew-hines.com/webinar.